Picture this. The sun dipping below the horizon, painting the sky over the Andaman Sea, viewed from your own amazing villa in, say, beautiful Phuket. Or maybe it's the quiet calm of a private escape tucked away on a perfect beach on Koh Samui. For a lot of people, owning property in Thailand isn't just some far-off fantasy. It's a real goal, a dream of luxury, maybe peace. But making that dream happen, especially if you're a foreigner, well, it has some unique complexities, some interesting twists and turns. Welcome to the Deep Dive. Today we're diving deep into the intricate world of foreign property ownership in Thailand. We're going to focus particularly on a strategy many people use, holding property through a Thai company. Now, our guide for this exploration is a really insightful article. It's called Thai Property Ownership, Company Holdings, Tax, and Visas, and it comes straight from the blog of Ocean Worldwide. And Ocean Worldwide isn't just any agency. They're a top-tier luxury residential real estate agency, actually based right there in Phuket, and they've been there since 2004. Their director, Sandra O'Neill, has personally guided literally thousands of families and property investors through this exact process over the years. So their experience, invaluable for us today. Our mission then is to unpack all the details, the surprising upsides, and yes, the potential hurdles of using a company. By the end of this, you should walk away feeling really well-informed about making such a big investment in your own slice of Thai paradise. Okay, so the pull of Thailand, it's strong, right? But for many people dreaming of owning property there, that first obstacle can be a bit of a shock. You generally can't just buy land directly if you're a foreigner. So how do you even get started? Why is setting up a company even part of the conversation for foreigners wanting to buy property?
Yeah, that's the absolute core of it. You've hit it. That fundamental restriction in Thai law means foreigners are generally barred from owning land outright. So if you want a house which obviously sits on land or you want to buy land itself, maybe to build on, the company route becomes, well, the main way to do it. It's a legal structure to gain indirect ownership.
Okay, indirect ownership makes sense.
And the crucial rule here, the one you absolutely have to understand, is the 51% Thai shareholding rule. For a company to be legally seen as Thai and therefore able to own land, at least 51% of its shares must be held by Thai nationals.
51%? Okay.
But it's not just about the numbers. This is where significant risk comes in. The Thai authorities, especially the land department, are extremely vigilant. They look very closely at arrangements where Thai nationals might just be holding shares on paper, to meet the rule without any real involvement or investment.
So they're looking for genuine participation, not just names. What are they worried about specifically? And what happens if they think it's just sort of a front?
Exactly. They are very concerned about what they call nominee shareholders. Using nominees is seen as trying to get around the foreign ownership laws. It's a serious issue. If they determine it's a nominee setup, the consequences can be severe. Your whole property purchase could be deemed invalid. You could potentially lose the property entirely. It's a massive risk people sometimes underestimate.
Wow. Okay, so definitely not a simple loophole then.
Not at all. Now, legitimately, you often see this structure used when someone buys a house with their Thai spouse, where the spouse genuinely holds the Thai shares, or, by property developers buying land for larger projects. In those cases, there's usually real substance.
That clarifies the nominee risk significantly.
Later.
High stakes. Okay, moving beyond just legally holding the property, what about the financial side? What are the actual tax benefits that using a company structure might offer? Because that's often a big draw for investors, isn't it?
Absolutely. And there can be some real advantages. One major one is leveraging double taxation agreements, or DTAs. Thailand has these treaties with many countries. Basically, they're designed to stop you or your company from being taxed on the same income twice, once in Thailand and once somewhere else. So taxes paid overseas might be creditable against your Thai tax bill, potentially lowering your overall burden here.
Okay, that makes sense. Avoiding double tax.
Then there's capital gains tax. When you eventually sell the property, how the sale is structured through the company can offer ways to mitigate the impact of capital gains tax. Compared to selling as an individual, there can be strategies depending on how profits are handled or maybe reinvested. It allows for more planning.
Right, so it's about smart management, not evasion, but optimizing within the rules. That could add up over time.
Precisely. And another key area is rental income. If you rent the property out, operating through a company allows you to deduct a whole range of legitimate business expenses against that rental income. This can really bring down your taxable profit from the rent quite significantly.
Okay, deductible expenses. Like what specifically? What kind of things can you typically write off?
Sure. The source mentions things like property management fees, very common if you're managing from afar. Then there are costs for repairs and maintenance, naturally. property taxes themselves, insurance premiums for the property, even interest paid on loans taken out to buy or improve the property.
Quite a list.
These are all generally allowable deductions that directly reduce the income you pay tax on. And another interesting one, specifically for residential rentals, is depreciation. You can claim depreciation on the building, typically spread over 30 years. So, for example, a property valued at, say, 3.9 million Thai baht, that's roughly 100,000 US dollars, could potentially allow for an annual depreciation deduction of around 130,000 baht.
130,000 bahts just from depreciation. Wow.
Yeah, and that's a non-cash deduction, meaning it reduces your taxable income without you actually spending that money in that year. It can definitely improve your net return.
That really highlights the financial upside. But it sounds like it comes with responsibilities too, right? It's not just benefits.
Oh, absolutely. Which actually raises a really important related question. How do these company strategies connect with an expat's personal income tax situation in Thailand, especially with some of the recent changes we've seen? That's a whole other layer.
Ah, yes, the personal tax changes. That caused quite a stir.
Indeed. The rules around bringing foreign income into Thailand have changed quite significantly, really starting from 2024. It used to be that you could bring in foreign-sourced income earned in previous years without it being taxed in Thailand if you timed it right. Now, the general understanding is that foreign-sourced income that was earned from January 1st, 2024 onwards is potentially taxable if you bring it into Thailand while you are a Thai tax resident. And tax resident usually means you're in the country for 180 days or more in that calendar year.
Right. So the timing of earning it is now key.
Exactly, when it was earned and when it's brought in. Now, there is some ongoing discussion about a possible 2-year grace period for income earned in 2024, allowing remittance maybe without tax until the end of 2025. But the bigger picture is that old strategy of holding foreign income offshore and bringing it in later, tax-free, that's largely closed off for income earned from 2024.
Okay, so just to be crystal clear for listeners, if I'm an expat, I earn money abroad in say 2024 or 2025, and I bring that money into Thailand in 2026 while I'm a tax resident here, I could face Thai tax on that income.
That's the current understanding, yes. It really changes the game for financial planning, especially for people relying on foreign income streams or planning large transfers.
Are there any exemptions still? Ways to bring money in without tax?
Yes, there are still important exemptions. Income you earn before you first became a Thai tax resident is generally okay if brought in later. Also, things like payouts from life insurance policies, inheritance. Although remember that 100 million baht threshold we mentioned for inheritance tax itself, certain foreign government pensions like U.S. Social Security or Canadian pensions, and typically gifts are exempt.
Okay. Some key exemptions remain.
And of course, Thailand has a progressive tax system. The first 150,000 baht of your total annual assessable income is tax exempt anyway.
So with all these moving parts, how can expats actually plan effectively and avoid nasty surprises? It sounds like paperwork is crucial.
You absolutely said it. Professional advice tailored to your specific situation is critical, and meticulous record keeping is more important than ever. You need proof of when income was earned, where it came from, and your residency status during different periods. This documentation is vital if you need to show income predates the rule changes or was earned when you weren't a tax resident here. Get it wrong, and the penalties can be significant.
Right. Definitely not something to guess at. Get advice, keep records. Got it.
Okay, so if we connect that personal side back to the bigger picture,
Yeah.
what about the company itself? What are the broader corporate tax realities and sort of fundamental ownership rules investors need to be aware of?
Good point. The company has its own obligations.
It does. And for a very small subset of listeners, perhaps those with larger international business structures, there's the global minimum corporate tax to consider. Basically, if your Thai property company is part of a bigger multinational group you own, and the effective corporate tax rate paid in Thailand is below the global minimum, which is currently 15%, other countries where your wider group operates might be able to collect the difference. It's complex, mainly for big players, but worth knowing it exists.
Okay, something for the bigger international investors to watch. What about for most people setting up a single property company?
For pretty much everyone, the key is rigorous compliance. Accurate records for all those deductible expenses we talked about are non-negotiable. Companies have to file tax returns regularly, quarterly, and annually. They need a Thai tax ID number. And you really don't want to mess this up. Non-compliance. Penalties can include fines up to twice the tax owed, plus monthly interest around 1.5%. In cases of deliberate evasion, there could even be criminal charges.
Serious stuff.
Absolutely. And adding to the transparency push is the Common Reporting Standard, or CRS. This is a global initiative. Essentially, over 120 countries automatically exchange information about financial accounts held by foreign residents. So, Thai tax authorities are getting data about accounts Thai residents hold overseas. It underlines the need for accurate reporting, especially since Thai tax audits can potentially look back 5 years or even 10 if they suspect fraud.
Wow, the transparency is really increasing globally.
It really is. And interestingly, the article notes that in early 2025, places like Phuket, Rayong, and Samui were the only areas seeing an increase in residential property transfers right after the government brought in measures targeting those nominee ownership structures. It shows they're actively enforcing this.
Clear signal indeed. Okay, let's nail down a core concept. Freehold versus leasehold. We hear these terms all the time. What's the difference in Thailand, and why does it matter so much for foreigners?
Great question. It's fundamental. Freehold is what most people think of as ownership. You own the property and the land it sits on outright forever, like in many Western countries. But in Thailand, as we said, foreigners generally cannot own land freehold. That's the restriction. So leasehold becomes the common solution for land. With a leasehold, you don't own the land itself, but you secure a long-term right to use it. Typically, this is for 30 years, and often it can be renewed, sometimes multiple times, depending on the agreement.
So you control the land use for a long time, but don't technically own it.
Exactly, and importantly, you can usually own the building or house that sits on the leased land freehold. So you own the structure, but lease the ground it's on.
Okay, so the building ownership is separate from the land.
Correct. And these limitations on direct land ownership are precisely why foreigners often turn to either the company structure we've been discussing, with its 51% Thai shareholding, or these long-term lease agreements as the main ways to control and use land in Thailand.
Got it. That clarifies the distinction. So we've covered the complexities of buying and owning, but what about actually living there, managing the property long-term and eventually passing it on? What's the deal with visas and inheritance?
Right, crucial practicalities. And here's a really important point that catches people out. Owning property in Thailand, whether it's a condo freehold or land through a company, does not automatically give you the right to live there. It doesn't grant you a visa or residency.
Oh, really? That's a common assumption, I think.
It is, but it's wrong. You need to sort out your immigration status separately. Owning property is an investment. Living there requires a visa.
Okay, so what are the typical long-term visa options then?
Well, there are several. For those over 50, the retirement visa is very popular, assuming you meet the financial requirements, usually income or savings thresholds. There's the DTV or digital nomad visa, which is newer. And the SMART visa, aimed at specific skilled professionals or investors in targeted industries, but that has quite high criteria.
And what about the elite visa? We hear about that one linking to investment sometimes.
Yes, the Thailand Elite Visa often complements property ownership well. It offers long-term residency options ranging from 5 up to 20 years. It usually requires a significant fee or investment, often around 10 million Thai baht or more, which can sometimes be held in property, fixed deposits, or government bonds, depending on the specific program rules at the time. It comes with valuable perks, too, like VIP airport assistance, help with driving licenses, bank accounts. It smooths out the practicalities of living long-term.
Okay, so the elite visa is a key one to look at for long-term residency tied potentially to investment. What about inheritance? Passing the property on.
Good news for most people here. Thailand does have an inheritance tax, but the threshold is very high. It only kicks in if the total value of the estate passed on exceeds 100 million Thai baht.
100 million baht, that's quite high.
It is. Below that, there's no inheritance tax. If it does exceed the threshold, the rate is relatively low. 5% for direct descendants or spouses and 10% for other beneficiaries.
And how do you ensure the property goes where you want it to?
A properly drafted Thai will is absolutely essential. Don't rely on a will from your home country. A Thai will simplifies the process immensely for your beneficiaries and ensures your wishes regarding your Thai assets are followed according to Thai law. If the property is held within that company structure, then succession planning means planning the transfer of the company's shares. This needs careful thought, potentially outlined in your will or within the company's articles of association.
Right, transferring shares, not the property deed directly. Makes sense.
And finally, what about renting it out? Any pitfalls there? A couple of key things. Short-term rentals, think Airbnb, usually less than 30 days, generally require a hotel license in Thailand. That can be quite difficult for an individual owner to get. It's a significant hurdle. For longer-term rentals, though, Thai law tends to be reasonably landlord-friendly. Having a clear, well-drafted, legally sound rental agreement is vital. And of course, all rental income you receive is taxable income in Thailand. But remember what we said earlier, you can offset that income with legitimate property-related expenses. Maintenance, management fees, repairs, insurance, depreciation, that helps reduce the tax bite.
Okay, so long-term rentals are generally simpler, but declare the income and track your expenses. Got it. Phew, that was a lot. So bringing it all together, what does this mean for you, the listener, if you're dreaming of that place in Phuket or finding serenity on Koh Samui? It sounds like an incredible opportunity, but definitely one where you need to know the rules of the game.
That really sums it up. Deciding whether to use a Thai company for property ownership is a very personal choice. There are clear potential upsides, particularly around tax optimization with deductions and navigating those foreign income rules we discussed, but you absolutely have to weigh that against the administrative burdens setting up and maintaining the company isn't trivial. And the legal complexities are very real, especially ensuring that 51% Thai shareholding is genuine and avoids any hint of being a nominee arrangement. Plus, there are ongoing compliance duties. It's definitely not a set-and-forget strategy.
Constant vigilance needed, it sounds like.
Pretty much. Which leads back to the most important piece of advice, really. Get professional, tailored guidance before you commit to anything. Talk to experienced lawyers and accountants who specialize in Thai property and foreign ownership. It is just too easy to get tripped up by the details, and the consequences can be painful.
Sound advice. Don't try to navigate this maze alone.
Exactly. And looking ahead, there's sometimes talk of potential price adjustments or even a price war in certain property sectors. It makes you wonder, how might these complex ownership and tax strategies need to evolve for investors in the future? As the market shifts, what new opportunities or maybe new challenges might pop up for people trying to secure their own piece of paradise? It's a dynamic landscape.
Definitely something to keep an eye on, a lot to think about. Ultimately, if you're exploring property in Thailand, it seems crucial to consider what really matters for your own long-term security, your investment aims, and your willingness to really understand and engage with the local system. Hopefully, this deep dive gives you a solid foundation for that journey.